Leverage ratios are often considered when analyzing fundamental data for a company. They usually consider the liquidity or bill-paying ability of the company. Low liquidity can be a signal of bankruptcy. Leverage ratios vary immensely across industries, so comparisons should be done to peers within the industry. The use of debt and equity are financing decisions that every company must make. Market and economic conditions affect the decisions as each funding source is associated with risks and costs. Total debt to total assets ratio compares total debt to total assets from the latest balance sheet. Lower is typically better as it implies there is less debt burden on the company. For example, a company with $10 million in total debt and $50 million in total assets would have a total debt to total assets ratio of 20%. A company with the same level of debt but only $25 million in total assets would have a higher ratio of 40%. The first company has less debt in their capital structure and more flexibility in financing decisions. Advantages of leverage ratios are that they are easy to compute and to understand. The ratios give valuable information about a company's operations. Disadvantages include that ratios are not comparable across industries, which can make evaluating the companies very difficult. The general trend in a ratio over time is informative. Falling leverage ratios may imply that a company's liquidity is declining or may hold other information about a company's cash management and debt levels. Viewing the components of each ratio separately can be helpful as well. If the total debt to total assets ratio is falling, is this because total debt levels are decreasing or are total assets increasing? Or could this be a combination of both? In this example, Ford's total debt to total assets ratio is currently at 57%. It has oscillated within a fairly tight range of 52 to 72% over the period. A lower leverage ratio is preferred, though many industries use debt heavily and use of debt is often wise. Less debt might mean a stronger balance sheet, less risk to equity investors, less leverage, and more liquidity. More debt might mean more profitability. It would be wise to view the financial statements to learn more. Norms tend to be very industry specific as well.